It has been a better day on US markets, particularly tech. Can we say with confidence that the bottom is in, or is this just a breather because valuations are still looking pretty rich?
Well, we're still pretty constructive on equities, particularly U.S. equities. We think that the U.S. has more room to run. Certainly, the consumer has proven more resilient than we had originally forecast, and you're starting to see perhaps the light at the end of the tunnel as the Fed completes its hiking cycle.
Yeah, in terms of the Fed, you say the light at the end of the tunnel. I know you think that maybe the Fed's done enough, but how certain can you be that the tightening rhetoric that we're hearing out of the Fed is just that, rhetoric, jawboning?
Well, it's never certain when you're talking about the Fed because obviously they want to try to keep markets a bit on their toes. But we actually think that the combination of the hikes that they've made already this far, as well as other tightening financial conditions, have really done the job. Now, that doesn't mean to say that they won't take another bite at the apple in September or perhaps two more, but we actually think that each incremental hike that they have from here just raises the risk that we have a much sharper slowdown in 2024 and perhaps even a recession. So as long as inflation remains contained, we think that they will take a pause here. But of course, we'll hear more from Chairman Powell later this week.
Lori, so you just mentioned that you are still overweight equities, but in your notes you say that cash is also attractive. So what's behind that allocation?
Well, it really is not really liking bonds very much right here. We certainly are becoming more constructive as we start to see 10 years get up over that 4% level. But as your earlier guest noted, we may see bond yields back up still further from here. So the big plays are really almost like a barbell. We are overweight equities, primarily taking that overweight in U.S. stocks, and then we're holding a fair amount of cash, both because we don't really like credit in here and because we want to wait for better opportunities elsewhere.
And would that elsewhere include overseas markets?
It very well might. Overseas, we've been more constructive on Europe, although we've recently lightened up our overweights there because we just feel that the U.S. proves more resilient in this environment. But we're not really getting very excited about Asia just yet. We believe that the China story is going to continue to weigh on the region. And while there might be some bright lights like Japan, just a lot of concern about how that will play through in the Asian markets.
Lori, to your point on Asia markets, we do have a chart on the Bloomberg that shows half of the Hang Seng index now oversold. And there's a whole suite of superlatives when it comes to China. $1.5 trillion worth of market cap wiped out. We've had 11 days of net selling over the Stock Connect as well. What would change your attitude on China? You know, do you anticipate any meaningful stimulus coming out of policymakers?
Well, one of the challenges with China right now is that we will see some stimulus, we believe, but it won't be enough to really stop the decline. And we expect that this property market kind of rehabilitation is going to take several years and probably be a headwind for growth in China for quite a bit of time. And keep in mind that that's against a backdrop where global growth is also slowing. So there's not really any release valve for China right now. So we're just not very constructive there.